Hello, and welcome to our vodcast on long-term care insurance design. Okay, let's get into our discussion of long-term care insurance design, and I want to keep it simple. There are three basic designs of long-term care insurance protection. There is the reimbursement model, which is the most popular, and then there is a cash model, and there's also a combination reimbursement and cash model. The reimbursement model means exactly what the name implies. You receive your care, you pay for the care, and on a monthly basis, you are reimbursed for those expenses by the insurance company. The reimbursement model is a very cost-effective type of long-term care protection. If you have the cash model of long-term care insurance, every month you receive a check in the amount of the monthly amount stated in the contract. The cash model usually costs more than the reimbursement model, but cash is of course much more flexible in different long-term care situations. The first step to consider when designing your long-term care protection is the benefit amount. The benefit amount can be expressed as either a daily benefit or a monthly benefit. The benefit amount you choose can reflect the going rate of long-term care cost in your area. Let's say $200 a day or $6,000 a month. Or you can choose a rate that helps you control total premium cost. Let's say $100 a day or $3,000 a month. And use it with other assets designated for long-term care expenses. Long-term care expenses differ throughout the U.S. Essentially, it depends on labor cost in a particular area and supply and demand. New York is different from California, and Florida is different from Texas. After you choose a benefit amount, you need to decide on the benefit period or length of time for benefits to be paid. Most benefit periods start at 2 years and go all the way up to lifetime. Total benefits are expressed as a pool of money. For example, $5,000 a month for 5 years will generate $60,000 a year. For 5 years, that's going to total $300,000, which would be the pool of money. An important note here, if you do not use your coverage at a rate of $5,000 a month, the benefit could go beyond the 5 years. The last key area of design that we haven't talked about yet is inflation. Inflation protection is important. As we move into the future, you want your benefit amount to inflate and grow larger. Some of the choices for inflation are 5% compound, which means the benefit will double in 15 years. You may choose 5% simple, which means the benefit's going to double in approximately 20 years. Or you can purchase a consumer price index type of inflation. Companies offer many different types of optional riders for different needs, but the bulk of design is in the area of benefit amount, benefit period, and inflation. Proper long-term care planning is not a cookie cutter or one-size-fits-all approach. One needs to sit down with a long-term care planning specialist and have an extensive discovery session. This will help to design a long-term care plan that makes sense for the client and fits within his or her budget. To obtain more information on the topic of long-term care planning, please go to my website, longtermcareman.com, and sign up for one of my 30-minute no-cost discovery teleconferences. Thanks for viewing, and talk to you soon.